Okay, so now what we're going to do, we're in chapter 13. We're looking at accounting for derivatives. This is kind of like a part 2 of our last chapter. And if I have time, we'll discuss how deep we can get on these hedges. I might have time to talk about collars. We'll see how the PowerPoint goes. I don't want it to get too long. So, because if I get it too long, it won't download to my computer. So, since we're putting everything online this semester. So, the first thing we're going to do is talk about derivative instruments, talk about the cash flow hedge, look at how we would hedge for cash flow, if it's accounted for as a cash flow hedge. And again, that is kind of speaking again to that whole foreign currency item. We're going to look at the definition of a fair value hedge and the circumstances in which a derivative is accounted for at fair value. So as things are, going, we're going to be walking towards the fair value. And then we're going to account for the cash flow hedge from an inception to settlement. So that'll be our last little objective. So, three more. We're going to understand the special derivative accounting related to foreign currency denominated receivables and payables. If there's time, we'll talk about IASB and footnotes. Okay, so let's go ahead and get started. Remember from a previous chapter, the definition of a hedge. It's basically to reduce risk. It's an insurance policy. I love to call it an insurance policy, and it helps manage risks. It helps reduce risks, and also helping avoid bankruptcy. Okay, so it can, in hedge accounting, you're going to look at the relationship between the items cost on the balance sheet, hedged items cost, and the derivative instrument and how it is fluctuating. And then you're going to look at trying to set up a risk management objective and strategy for the items and assessing the effectiveness of a hedge. So this is the chapter we're going to start looking at whether or not that hedge we bought actually did its job, and then we will be accounting for its effectiveness. Okay, so in hedge accounting, the derivative must be highly effective at offsetting gains and losses. So for example, if you buy a derivative and it doesn't do its job, for whatever reason, let's say you buy a derivative that things are going to gain and then they lose, and you lose the buy on the derivative. That's a very, very simple way of saying it. It gets very more complicated than that, but just to let you know, was it worth it? Could you have gotten the same effect without buying a derivative? For example, if you hedge against something, it doesn't happen, then you didn't need that derivative at all. Then, we have to account for hedge effectiveness, basically. So the effectiveness basically considers the nature of the underlying variable, the notional amount of the derivative and the item being hedged, the delivery date of the derivative, and the settlement date of the underlying item that's being hedged. And when we say variable, it could be just about anything. I know I talked about oil and gas in a previous chapter. It's a great example of an underlying variable. It could be foreign currency. Maybe you run out and invest in foreign currency to take over, to make money on that. Okay. So here are some examples of items that you can hedge. You could also hedge accounts payable, and this is one where we are going to hedge accounts payable that's due January 1st, 2017, for the delivery of 10,000 euros. And the variable of changing values we're going to be hedging is euros. The hedge instrument is a forward contract to accept the delivery of the euros on January 1st. All right, in critical terms of the item being hedged, and the hedge instrument do not match, then you can use statistical analysis to determine the effectiveness. You could use either regression or correlation. These two types can be used, or you can do regression and correlation. Go all out on yourself. So using derivatives based on heating oil or crude oil to hedge jet fuel costs. Okay, so here's your example. Okay, so now let's look at accounting for derivatives and hedging activities. All right, so a cash flow hedge is when the anticipated forecasted transactions, when you're using it for forecasted transaction where there's a risk of variability in future cash flows. So great example, anything that has to do with foreign currency, there could be risks there. I mean, it could go all over the place. So it's recorded at cost and it's adjusted to fair value on each reporting date. Now, the cash flow hedge fluctuates every single day because cash and its worth fluctuates. But in this particular place, we pick a date and we stick with it. The other thing is this goes in OCI. So we don't put a cash flow hedge. We don't hedge for cash flow on our operating income. This is something that's supposed to kind of show outside of on the income statement in a separate line item so that a company doesn't get rewarded for good hedge accounting as far as it shows below operating income. That way it can be assessed as what it is. The other thing is when the forecasted transaction does impact the income statement, either gain or loss, then you can reclassify this as hedged revenue or hedged expense. Okay. All right. So a fair value hedge is used for an asset or liability position or a firm purchase or sale commitment. Okay. So example, the oil and gas, where there is a risk of variability in the value of the position. All right. So both the item being hedged and the derivative are adjusted to fair value at each reporting date and are accounted for immediately with offsetting gains or losses. So you want it. The big goal here with fair value hedge is to show whatever is being out there at fair value and its derivative as a gain or loss in income, and it basically is to show it separate on the income statement so that it doesn't inappropriately affect and give more information to those outside investors as, okay, here's where we did this fair value hedge. It's not related to our general operations. This is just something we did to make sure that we don't lose a bunch of money because of whatever currency fluctuation or whatnot. So that's basically what it is. Also, it shows that you protected your fair value, whatever it might be, jet fuel or whatnot. I just read an article about jet fuel. It's rolling around in the back of my mind. And if I have, depending on how many minutes this slide goes by, we might chat about that really quickly at the end of the lecture too. All right, so let's look at cash flow hedge example 1. A utility is purchasing oil for its sale to customers on December 1st. The utility enters into a futures contract to acquire 4,200 gallons of oil at 1.4007 per gallon. There's a margin of 10 to be paid up front. All right. And that margin is the cost of the hedge. So anything that fluctuates around here, if it doesn't land right on that, actually, that's not completely true. All within up or down of this amount is going to be a measurement of the hedge effectiveness. So this $10 is a hedge cost. So depending on where it lands, either up or down, probably up would show the most effective hedge. We're going to measure that $10 on whether or not it was worth it. Okay, so it will be a little more clear on the second page. So the price of delivery was this 1.4050, and then the spot rate on January 31st, it went down. So in 3 different positions. All right, what we contracted at, where it was at the end of the year, December 31st, and then actually the delivery date. So we have a rate, an up and a down, and then we're going to be basing this amount, multiplying this times the 4,200 gallons. So let's see what this looks like. Okay, so here we are on 12/1. This is what we bought it for. And I'm going to pull up my calculator too. So you can see sometimes it's a little harder to write this in. It's a little easier to throw it on the calculator here. So let's just do this really quick. 1.40007 right here. All right, and then we'll multiply it, use a multiply, times the amount of 4,200. Okay, and that's where we're getting our 5882.94. We just multiply it out. All right, so we do the same thing with the 1.4050, and the way we come up with our $18.06 is we're going to subtract this. Oops. All right, and you can see me hitting the subtraction right up here, minus the 5882.94, and that's where we have our 1806. Okay, so on 1231, our futures contract change is 1806. Now, on 131, it went down quite a bit. You can see right here, it went down quite a bit. All right, so that little tiny amount actually went down by 2310. So we have a loss on contract, all right, of other comprehensive income. And we're going to put this to cost of sales, all right. Also, we can look here and do some rating on effectiveness. Let's take a look. All right, so our contract, this is our contract was 10. All right, that's when we signed it. All right, at the end of the year, we debit our futures contract for the increase because it went up. And then here, we're going to flip it, right? And we're going to flip it out of OCI, which we took in other comprehensive income at the end of the year. We'll flip it out, credit our futures contract on 131, which was the delivery date. All right. Now, once we've got that all sorted out, all right, we're going to take it. We take our contract. Remember, we pay our contract on delivery, right? So we'll collect the balance in the margin on the delivery date. Remember, it's originally out here at 10, all right? We're going to credit it for the difference in loss, all right, which is going to be the difference between this 23 right here, this 23 and 1806. This difference, all right, is going to be the difference in the futures contract. All right, so we have to go ahead and take that into cash, and then we'll go ahead and take the inventory once it's been paid for. All right, the other situation we're going to look at is, remember we had $10 in that contract, right? So we took out that 4. We also have our cost of sales as related to that because we contracted for 10, right? So we have 496 out there minus 4 point. It's always like a hard number for me to write in. 9s and 6s are tough. There we go. That's where our 504 is coming from right here. All right, and then here's where we take the item into inventory and we record the sales. They also had sales right here. So these are how we reclassify it, and this is how we take it into other comprehensive income in our journal entries. All right, so let's look at the example number 2 for cash flow hedge. We anticipate a purchasing equipment on 3/1/17 with a payment of, I think this is pounds, 500,000. They sign a 90-day forward contract to buy 500,000 for $1.68, and the spot rate is $1.70. Okay, so it's a 90-day forward. So here comes your favorite thing. I know you don't like to do present value and future value, and I know you don't like implied interest, but I figure as much as you've done in previous chapters, you should be pros at it. So the $10,000 contract discount will be amortized to exchange gain over 3 months using effective interest. Okay, so the implied interest is going to be as follows. The present value is what we're doing right now, which is the spot rate. So just a little here, present value to spot rate right over here, spot rate here. Here's our PV rate right here. So that's where we're going to get our 850. The future value is going to be our 90-day forward, right? So in 90 days, it's going to be $1.68. So we divide or multiply it times the 500,000, and this is where we get our future value right here. Okay, over 3 months. Now, if you want to do the present value calculation in Excel, if you've had me before, then you know how to put this in your Excel spreadsheet. If you haven't had me before, you can still put it in very easily into your Excel spreadsheet. And all you have to do is hit the equal sign, type in the word rate, your number of periods, which is 3 months. Do it in months because we're not adding it over 90 periods. We just have 3 months, right? Put in the number 0 for payment because you're not getting any payment. Put in the present value, which you've already figured out from your calc, and then put in the future value as a negative number. See right here? Put a minus sign in, put it in as a negative number. All right, and then this is your result. Take this amount and use that decimal amount. We're going to be pulling that out later on in this example from previous slide. So now what we're going to do is we're going to go in and look at this cash flow hedge and the forward rates and fair value of the contract. Okay, so what we just did, we're kind of come in here and sort out our notional. This is called the notional amount. All right, and as we go through here, as we get to the end, our forward rates have come up. 1231 is 169, 31 is 172, and if I multiply these amounts right here, multiply these amounts by 500,000, right? Make that scratch over there. That is where I get these notional amounts right here. Multiply this times this. All right. So the next thing we're going to do is look at the contract. It's adjusted to its discounted fair value. Okay. So we're going to use the incremental borrowing rate of 12% or 1% monthly. So if it's monthly, then you have to go in and on 12/31, the contract's fair value, all right, you're going to use it. You're going to take the $5,000, which is the contract value, and divide it by 1.01. This means that this is 1 month, all right? So grab the 5,000, all right? You're pulling up 1 month, all right? So 1.01, and then to the second, all right? So that shows to the second. So it's equal to basically doubling, or I'm sorry, putting it to the second power. All right, so that shows, so that's how you get that 1% squared. All right. Now, if you do the end of the contract, all right, to the end of the contract, it comes up to $15,000. That's at the end of the contract. And then 131 is equal to the fair value. So actually, when you're looking at it, it's because we're doing a forward, we're getting closer and closer, right? So it's a little bit backwards, discounted fair, it's a little bit backwards, so you square it. Okay, so let's look at, all right, so let's look at the accounting examples. And I also have this for your enjoyment on the spreadsheets, explained pretty well, in my opinion, on how to do the squaring and such. All right, so the forward contract on 12/31, all right, which we just did the calculation for, you're going to go ahead and debit that forward contract and credit OCI to bring it to the discounted fair value. Then on the last, you're going to, on the same at the end of the year, you're going to take that figure that you pulled out for amortization, the effective interest amount, and multiply it out to get this on other comprehensive income. All right, so on first, there's a lot of things going on. First, you're going to debit the forward contract and credit OCI. Then you're going to bring in the cash and the forward contract. The equipment's going to go on, and then you're going to show an exchange gain, and that is the difference between the amortization you figured earlier and the $10,000 for its remaining amortization. I'm going to run through this liability pretty quick. So they're buying equipment costing 200,000 yen on 12/2 with a payment due on 1/30/17. Here are some figures here. On 12/2 they entered a forward contract, purchased 200,000 yen on 1/31, so it's about 2 months away at a forward contract rate of 0.0095. All right, so at the end of each month and at the end of the period, or at the end of the year and at the end of 1/30, we're going to be having we're going to adjust it to we're going to look at the forward rate and the contract rate, and we're going to look at the contract receivables, and we're going to adjust properly. All right, for the liability. Okay, so first off, let's look at the dates here. We're going to look at the, I was getting so good at doing this. And then first one, okay. I want to put in the days just so you can see where I'm heading with all this. So on December, this would be our December 3rd here. This is our December 31. Mouse drawing with the fingers. And then this is our January 31 date for 1960, just so you can see how this lines up. Okay, so from December 3rd to December 31st, from here to here, okay, our accounts payable actually went down. Our accounts payable went down in, I wouldn't say down in value, but the amount based on the hedge went down for the spot rate, or for the rate. So what happens is we run into a situation where, because we owe less, we have a gain. So if we want to figure out that gain, I take the 1880 and then I subtract out 1840 right here, 40. Okay, so because I owe less, that's a gain right here. Boom. Okay, and then what happens between that is the 1960, which is my January 31st time right here. Between that, December 31st and January 31st, it went that I now owe more. So the balance in accounts receivable went up to the tune of $120. From here to here is $120. So I have to record a loss because now I owe more, if that makes sense. Sometimes it's really easy. Even I struggle like making that conceptualization that the more I owe in accounts receivable, the more I have to pay out, so it's a loss. Okay, so now let's go the opposite direction and do our contract receivable. Okay, so we have the contract receivable is, the first one is 1900 based on, and I'm not going to put these down here, just know that these are December 3rd, right, D3, D31, and January 1st. I guess I could just throw it in real quick just to keep the explanation nice and tight. Okay, so between December 3rd and December 31st, all right, our contracts receivable went down by $40. You can see it right there. It went down. People don't owe us as much, right, because it's a receivable. So it went down, so I have a loss. These are easier to understand than AP, by the way. Then due to currency exchange, it went up by $100, so I have a gain, all right? So the total loss and gain on the transaction between everything, losses and gains on payables and losses and gains on receivables, and you can just see that they both cancel out. Like if you wanted to look at them side by side, here's a gain of 40, here's a loss of 40, here's a loss of 120, here's a gain of 100. So the difference is $20 right here. All right, so the net gain in December is a wash, right? So let's go back and look at December real quick. Here's our December gain, loss. December is a wash. January is not a wash. There's a net loss in January. So let's just go back and look at January really quick, just to like bring the point home. Loss, gain, but they're different amounts, 120, 100. So January ends up being a net loss. Okay, so the spread between the spot forward rate on 12/2 determines the total loss, or the cost of the hedging. So we had to pay for some hedging. Okay, so here are the journal entries. This is originally buying the equipment, contract receivable and payable, both receivable in the pound, payable in the dollar. All right, here's the gain in accounts payable and exchange gain, and here's the loss. And you can't see the second part, but it's 40. I'll just trust me. Okay, so again, you can see the differences in currency. Okay, and then here's where we do the 130 payout, and here's where we come in. And you can see right here, we wrote the exchange gain and loss separately, but they come out, they'll wash out very beautifully on our financial statement. So here's the contract payable in dollars and cash when we finally paid it. Here's the cash and contract receivable and exchange gain for the pounds. And here's where we go ahead and wash out the accounts payable for pounds and take it out, the loss. And these two will cover each other, and then it'll show the $20 difference. All right, I'm just going to walk through this really quickly so you can see the slides for footnotes. You can read these yourselves. Just stop the video and take a read. I don't want to go too far in it. Keep the video somewhat reasonable. And then last but not least, we have the IASB standards. And that's it. I appreciate y'all watching the video. I hope you enjoyed it, and I hope this helps you along in your homework. Thank you.